Good afternoon, my fellow students of America. Today we're going to be talking about a little bit more about some macroeconomics lesson. Today specifically we're going to be talking about the fractional banking system. Pretty much what that is how banks make money come out of thin air. Magical. Now let's just break this down a little bit. When you deposit money into a bank, the bank will hold it for you. But banks don't just hold your money forever, otherwise there'd be no profit made. And so instead of holding it, it loans it out. Now thankfully all banks, most banks at least, are not compulsive 10-year-old little kids who wait to spend all their money on the latest Minecraft update. By law, they're always supposed to have a minimum amount of money in their bank, what's called a reserve ratio. Reserve ratio is the minimum amount of money you can hold in the bank while still putting out money to other consumers, customers, etc. In America, our reserve ratio is 10%, the big 1-0. What does this mean for the other 90% though? Banks loan out to other banks and consumers, and it creates more money along the way, causing what's called the multiplier effect. The multiplier effect is a given change in input that causes a larger change in output. You ever heard the game bigger, better? That's almost the same thing. Now let's look at this as an example. Suppose your grandma gives you $100 because she knows you're a poor college student who needs money, like me. Well, instead of spending that money on useless items, you want to put that in the bank to save it for later. So you put the $100 in the bank. Now in the bank, they take 10% of that deposit and store it in the bank. That other $90 though, the 90% is loaned out to other clients, consumers, banks, etc. You still have $100 in the bank under your name and your account, but technically that $100 that you put in there is now sent out to other consumers. Now that $90 is now new money supply to other consumers and clients, banks, etc. Now, it doesn't end there. The person who now has $90 from that bank now goes and spends it on the latest Jonas Brothers album or ShamWow or the Outback Steakhouse for a date night or something. Either way, that money that's spent will gradually end up in the bank again. That bank will now have $90 in it, but they take 10% of that. They take 10% of the $90, which is $9, and they put it aside, and they have the $81 and they put that out. That's 81 new dollars in the new money supply. And that $81 didn't even exist. And this will continue taking place, so on and so forth, taking 10% of the 81 and then that goes into another part, taking 10% of that and that goes in. It's new money supply constantly being created as this money is going in and out of banks, creating new money supply. Now in the end, your initial deposit of $100 creates 900 new dollars of new money supply. Why, you may ask? We use the simplest equation in the world to find how this all works, and this is called the reserve ratio equation / money multiplier equation, blah 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 blah. I don't really know the name of this, but it's pretty much 1 divided by the reserve ratio, alright, which gives you the money multiplier to find the new money supply in the end. In this case, because we have $100, alright, our reserve ratio is 10%. We plug that into the formula. 1, just the 1 divided by 0.1, which is 10%. 1 divided by 10% gives us a multiplier of 10. Now you take this 10 multiplier and times it by $90. You don't times it by the $100 because that $100 is already part of the money supply. So you take the $100, they put it in the bank, they put 10% of it aside, like tithing. They put 10% of it aside, and then the $90. You take the $90 times that by 10 because that 90 is the new money supply. And that gives you $900 of new money supply throughout until it's all used. And that is the whole idea of fractional reserve banking. Banks hold a certain amount of money from a deposit and the rest go out to creating more money. And that is how it's done. Now if this is a little confusing to you, that is okay. It took me actually a couple months to figure out. When I learned this in class, it was kind of hard to put my mind around this, and but really it's simple. You put in a deposit, the bank takes 10% of that and holds on to it. They take the other 90% and that distributes it out to other consumers' banks, which goes into other banks, and take 10% of that and 90, blah, blah, blah. But constantly it's making new money supply, creating the multiplier effect. How we put in a small output, we get a larger output in the long run. By magic. And that's what I'm going to end with you guys today. If you guys have any questions, please do ask in the comment section below, or just take Brother Pooley's econ class, because he explains it 10 times more simple than I can. So you guys have a great day. My name is Brian. Happy to help you guys out today. Have a great day. We'll see you guys later.